Change is upon us. And what I'm talking about are these new Code Section 7702 regulations, which now allows you to pump in more premium into smaller death benefit policies so that more of your cash value goes to growth and less to fees while still maintaining the tax sanctuary of life insurance. Sounds great, right? Well, that's what we all thought when Congress passed this in early 2021 when everything was just theory. But now several companies have released the new and improved products, and we're seeing that it's not that cut and dry. So we have lots of examples to show you that we've been running for clients in terms of both old and new, whole life and IUL. And that's exactly what we're going to spend time comparing in this video. So let's jump in. So this is an IUL product from a mutual company. But if you're a whole life person, don't leave, because I think we're going to see the same pattern persist. And I have these percentages signs down here to show you the difference. And so what you can see is year one, if we just look at this, the difference between the surrender value of the new product and the surrender value of the old product is vastly different. It is, in fact, 23% more. But you can see that the actual dollar amount stays flat as we're pumping in $100,000 of premium for 7 years for this 40-year-old male. And so when we get to year 10, the difference isn't that much more, but there's a lot more cash value. And so we're talking about a 2% difference in cash by year 10. And that's even after dropping the death benefit considerably on both products. The other thing I want you to see is the new product versus the old product. And this is this running at the same rate and everything else. We're talking about a lot more death benefit for the old product, 164% more death benefit. And I know most of you don't care that much, or you say, hey, Hutch, I'm doing this for cash accumulation, and understandably so, but the juice was the juice worth the squeeze? Now, it doesn't matter. You can't really get the old product for this particular company anymore. Some of them are still out there, but if we compare and look at year 10, even after we dropped the death benefit, right? We actually dropped it after year 7. Oh my gosh. We're still talking about a pretty substantial amount of more death benefit for the old pre-7702 products. Now, 25 years out, this is come retirement age, we're not talking about a huge difference, right? There's only 12% more death benefit. And this is when the difference is the biggest, other than just that first year. We're talking about 5% more cash value. So in the long run, if your goals are the same, we're not talking about a huge difference. $14,000 of cash value on $100,000 of premium. After 7 were paid, $700,000 total. We're talking about $112,000 of cash value on over $2 million. Now, if we look at a stress tested version of the same policy that is still that first mutual company we're looking at 4% growth instead of a 5.47% growth, you can see that the difference isn't that vast. We're talking about very similar numbers for a lot less death benefit. Here's a different example, male age 42 with $50,000 of ongoing premiums for 25 years, totally different mutual company, different. We use 6% growth rate on this particular IUL. And what you can see is starting with more death benefit in the pre-7702 than the post. And although there's more cash value in the post than the pre, and it starts out with substantially more, 25 years later, especially as a percentage of premium, we're not talking about a ton of extra cash. Same thing if we look at a female age 59, 60,000 of premium for 7 years, starts off with more death benefit in the pre-7702 world than with the post, has more cash value throughout the period, but not substantially so 25 years out. So why are we seeing this pattern again over and over? I'll tell you, it has to do with what actually changed with 7702. And that was the internal actuarial interest rate assumptions that were lowered. Does that mean you'll actually get lower growth? No. But it means that when insurance companies build their products, they have to use a certain interest rate factor to figure out how much this premium would actually equal in terms of death benefit in the future. And when you use a lower interest rate assumption, you have to put more premium to equal the same amount of death benefit. Well, that's good. You get to put in less death benefit. But the insurance companies, they're very smart people. They hire actuaries to go, you know what, guys, since we're not going to be able to get as much growth off the money we're collecting, we can't offer as high of caps, as high as guaranteed growth on whole life, as high of dividends on whole life. And so therefore, we have to raise our internal cost per unit of insurance. So yes, you're getting less death benefit and being able to put in more premium. But what they did is they just kicked up the cost per unit of the insurance. Net, it's still better. It's still better, but not quite as good as we would hoped. And again, looking at those initial ratios, basically 164% more death benefit if you got the old one, and 25 years out, you only end up with 5% more cash value. But most people aren't buying IUL for the death benefit. It's more or less a necessary evil / incidental benefit to an IUL program. Net, what are we seeing across the board? That death benefits are down substantially. Cash value is up, really all ages, shapes, sizes, companies, products, even the stress tested version where we are purposely lowering the crediting rate to simulate an environment where interest rates stay down or volatility goes up, so caps come down. We're seeing more cash on cash. So if you've been waiting to do an IUL, you have some of your best options ever. You did miss out on a few years of compounding, which is a very important ingredient. But so now's the time to start exploring and seeing what options you have, because across the board, things are better. Whole life, a little more complicated, similar pattern, less death benefit, a little bit more cash value, but there also are some unique idiosyncrasies. So let's jump in and look at the numbers. Okay, so for whole life, we have a few different examples to show you. This is the first one. It's a 10-pay. Now, the way we've designed this 10-pay is we've actually added a term rider, so you can stuff in a lot more in the way of PUAs. The base premium for the 10-pay is only $71.63, like you see in the 9th and the 10th year. But above that, we're stuffing in a lot more. And over here, you see the old or pre-7702 version with a lot more death benefit than the post-7702 version with significantly less death benefit. And as we saw with the IUL, long-term, the post-7702 version does indeed beat the pre-7702 version. But what's interesting is that in the near run, it takes a few years to get there. You can see the pre-7702 version is ahead for the very beginning. And we're not talking about a huge differential in cash value to make up for this huge divergence in death benefit. But what's interesting and unique to whole life versus IUL is when we look at the guaranteed cash values of whole life, hence the word guarantees. If a carrier puts it in print, it has to be guaranteed. We can see that the guaranteed cash value of the pre-7702 version beats the post-7702 version, and by 25 years out, it's really crushing it. And the reason is simple. With whole life, unlike IUL, with whole life, your cash value has to equal the death benefit. And using an example of a pole vaulter, we just had the Olympics. The pole vaulter has to succeed. It has to scale that vault. And so if the pole vaulter is your cash value and it has to scale the vault, do you want that vault to be higher or lower? You want it to be higher, right? You want your death benefit to be higher because contractually, your cash value has to leap that. And even though by the time it leaps it's age 120, most of us probably won't live that long. I don't think I will. Still, he's on the trajectory to be heading towards that. So you definitely want your vault to be higher. So why is it winning in the current values? It's because the actuaries in the black box of these new whole life products have weighted more towards dividend participation. Now, it doesn't mean they raise the dividend rate. This is the same dividend for the post and the pre. We ran these together. What it means is the actuaries put a higher weighting towards dividend participation than to the guaranteed cash value. Well, what does that mean for you? It means less. There's another lever of control that the insurance company has, since less is going towards guarantees. We can look at one of these 90-10 policies and see a similar story. So this is one of the ones where it's 10% or somewhere thereabouts of base premium, and the other 90% approximately goes to PUAs and term rider. Over here, you see the pre-7702, $20,000 a year, same as the post, $20,000 a year for 7 years. Then after that, just base. You can see very clearly the pre-7702, you're paying $2,200, and that's for $535 of starting death benefit. A lot of that is term rider anyway, but what you can see is less premium towards more death benefit versus the post-7702 is $2,300 of premium towards $420 of starting death benefit. So more premium for less death benefit. Now, again, looking at these guaranteed values, you can see they never get close. It doesn't even touch the old whole life. These are the rails that everything runs on. Even when you stuff in PUAs, even when you earn dividends and you have them go towards PUAs, all that money gets lumped onto the guaranteed cash value, which, by the way, it means this old cash value number, not the old policy, but like any original illustration you saw with the guaranteed, you have to rerun a new in-force to get a new guaranteed cash value number because it's going to be bigger. The pole vault even just got higher. When we look at the current of the pre-7702 and post-7702, you can see that like the IUL and like the whole life 10 pay, the post-7702 wins 25 years out, but it actually takes about 12 years to get there. It takes 12 years to beat the pre-7702 in this case. Well, why is that? It's a very similar reason to what we saw with the IUL, is insurance companies, when Congress changed 7702 limits and they changed the actuarial factors that allowed you to put in more premium, insurance companies realized we have to collect more premium to promise the same amount of death benefit. So even though there's less death benefit to charge people for, we need to kind of raise the cost, the internal cost of insurance per unit of that death benefit. And that's exactly what happened here. So the PUA load used to be 5%, and now it's 10% for this. So 5% for this old policy, 10% for the new. Because on the new policy, they put a higher weighting towards dividend, it eventually outperforms, but it takes 12 years to do so to outrun that new, call it higher cost of insurance charge. With whole life, we can never look into the base policy because whole life is a black box, but I would imagine the calculations for premium to that death benefit are very similar to what we're seeing for what they declare as their PUA loads, their paid up addition loads. Before it's 5, now it's 10. So this is where it gets really interesting. Over here, we have a pre-7702, the best performing whole life policy, which isn't a 1090 or a 9010. It's a 1/3, 2/3, up against that 9010 with the new post-7702. And what we can see is there's a lot more death benefit for the pre. It starts with a little less cash value, but by year 3 has more cash value. And as we look down through the first 25 years, it has significantly more cash value than the post-7702 and a lot of extra death benefit too. Well, this is important because with the pre-7702, more of that is going to be laced into your guarantees. It's not able to be changed. There's not a lot of levers to be pulled there. And if we scroll forward in time, remember, this is a 45-year-old. So when we were looking 25 years out, that's the beginning of retirement age. Now, 31 years, we're well into retirement. Death benefit is actually a real thing. Well, that's a lot of extra cheddar in the way of death benefit that you have for heirs, which allows you to spend more of your other assets in retirement, knowing there's this backstop, this guaranteed accounts receivable. And if we go all the way out to age 94, 95, a lot more cash value, a lot more death benefit everywhere in between. It's the same story. So this unicorn is going to be going away soon because they haven't released their post-7702 policy. And I know some of you are saying, well, wait, listen, based on what we've seen, maybe their post-7702 is going to be even better. Maybe it will, maybe it won't. We don't know what they're going to do to those internal pricing mechanisms. For instance, the PUA load on this pre-7702 policy is, after year 1, is 5%. They may raise it like we've seen the other carriers do. They have a very low base to high death benefit, which is good because, again, your cash value has to equal that death benefit. Well, now you're going to be putting in more premium to equal less death benefit. So we don't know how that's going to play out. Could be better, could be worse. But regardless, a lot of you, especially those of you that haven't started yet, you may end up getting policies on multiple different family members. And wouldn't it make sense to get a policy with stronger guarantees and more death benefit for the higher income earning spouse? Also, maybe the older spouse, because death benefit then does matter, because like I said, that could be a backstop and accounts receivable that allows you to spend down other retirement assets during your life. And we could get the new policy, if it is that much better, on younger spouses, lower earning spouses, kids, because it'll actually, the way that 7702 works, it has a bigger impact for younger people, healthier people anyway, just how that calculation is factored in. So something to think about. It's not an either or conversation. Maybe it's time to get your foot in the door and get a piece of this unicorn before it is extinct, and layer on additional policies if they happen to be better in the future. Anyway, I hope you found this whole exercise valuable. If you haven't already, definitely check out more of our content. We have a lot of detailed content on our site, and you can always schedule a call with our team with this booking link here if you want to see how all of this plays out with your particular numbers. Hope you found this helpful, and we'll talk to you soon.